Welcome back to Investing Talk Podcast.
Today we're looking at energy fuels.
As usual, before we start, subscribe, like, and comment to this video to support the show.
Okay, let's unpack this. We're looking at a company today that, on the surface, looks like just another ticker in the resource sector. You scroll past it, maybe you see mining, maybe uranium, and you just move on. But looking at the research you've pulled, it feels like we're looking at something bigger than just a hole in the ground.
We absolutely are. If you look at energy fuels and just see miner, you are missing the entire forest for the trees. This isn't just about pulling rocks out of the ground in Utah or Arizona. This is about a company that is effectively positioning itself as a critical strategic asset in the United States supply chain.
Okay.
We are talking about the intersection of two massive macro trends that are colliding right now: a nuclear energy resurgence and a desperate, and I mean desperate, race for independence from China when it comes to rare earth elements.
See, that's the hook right there. But here is where I have to play the skeptic immediately.
Sure.
We hear strategic asset thrown around a lot in the commodity space. Every lithium junior miner with a patch of dirt and a shovel claims they are the key to national security.
Right.
Is this just another commodity cycle play riding the hype of the moment? Or is there actual structural change happening here? Because hype runs off, and it burns off fast. But structural change, that pays the rent for a decade.
That is the billion-dollar question. And I think the answer lies in the fact that energy fuels isn't just talking about what they might do in 5 years. They are actually executing right now. This isn't a PowerPoint company promising a mine in 2030. They are crushing targets today.
They're putting points on the board.
Exactly.
Well, let's stop talking about the narrative for a second and look under the hood at the fundamentals. Because talk is cheap, but guidance is binding. What do the actual numbers tell us?
Well, if we look at the operational performance, specifically the recent beats, it tells a very, very compelling story. Energy fuels didn't just meet their 2025 guidance, they exceeded it across the board.
Across the board. We are talking about finished uranium production, mined uranium production, and uranium concentrate sales. All green checks.
Okay, so they beat the numbers, that's good. But does a beat in 2025 guarantee anything for the long haul? I mean, companies beat estimates all the time by, sandbagging expectations.
That's fair.
What does this actually signal to you fundamentally about the health of the operation?
It signals that the operational ramp-up is actually working, mechanically. It's not just projected on a spreadsheet.
Right.
In mining, there is a massive difference between we plan to dig this up and we have successfully processed and sold this material. They are physically moving material and processing it more efficiently than they promised.
Yeah.
That is a massive validator.
Okay.
But honestly, if we want to talk about why this company is different, we have to talk about the crown jewel.
You're referring to the White Mesa Mill. I see it highlighted everywhere in the notes.
Exactly, the White Mesa Mill.
Yeah.
It is the only operational conventional uranium and rare earth processing facility in the United States.
Hold on, let's pause there and really let that sink in. The only one.
The only one.
In the entire United States, with all the infrastructure we have.
The only one. And that is where the economic moat gets really, really wide.
So why does this matter?
Because in this industry, the bottleneck isn't usually finding the ore. The Earth has plenty of uranium if you look hard enough. The bottleneck is processing it. It's the permitting, the chemistry, the waste disposal, all the regulatory hurdles.
Right.
By owning the only facility that can do this in the U.S., they have an incredible advantage. They are the gatekeepers.
So if I can use an analogy here, they aren't just the farmer growing the coffee beans. They own the only roasting plant in the entire state.
Precisely. If you want coffee, you have to go through them.
You have to go through them.
They are integrated. They are mining and processing. This creates a massive barrier to entry for any competitor. If you're a new miner, you either spend billions in 10 years fighting for permits to build your own mill, which is a nightmare.
A regulatory nightmare.
Or you have to knock on Energy Fuels' door and ask them to process your rocks. That gives them pricing power a pure-play miner simply doesn't have. They control the choke point.
That makes sense. It turns them into a toll collector as well as a producer. That's a powerful business model. But let's talk about the future, because they are spending some serious money to expand this, right? I'm seeing notes about a BFS, a bankable feasibility study?
Yes, for Phase 2 at White Mesa.
Okay.
And this is where the rare earth element, or REE, story really comes into play. The BFS outlines the economics of this expansion. The capital cost is projected at about $410 million US dollars.
$410 million. That is not pocket change. For a mid-cap company, that is a significant bet.
It is a huge bet.
Yeah.
But you have to look at what that investment buys them. The study isn't just about the cost to build, it's about the cost to produce once it's built. The efficiency metrics here are staggering. The all-in production cost for NdPr equivalent is projected at just $29.39 per kilogram.
Okay, let's break that down. First, NdPr. We hear this acronym a lot. Neodymium praseodymium. Why should the average investor care about those two elements?
Think of NdPr as the vitamins of modern industry. You need them for the high-strength permanent magnets that go into electric vehicle motors, wind turbines, and advanced defense systems.
Fighter jets, that kind of thing.
Exactly. Without NdPr, the green transition effectively stops.
Got it. So, critical demand. Now, that price, $29.39 a kilo. Put that in context for me. Is that actually good?
It's exceptionally competitive. It positions them as a low-cost producer.
And in commodities, low cost always wins.
Always. Because you can survive the price dips. If you can produce at $29 when the market is at $50, you're printing money. But more importantly, the market crashes to $35, you're still profitable while your competitors are going bankrupt. That cost profile is their safety net.
So they are spending that $410 million to ensure they are the low-cost leader. That's a strategy I can respect. It's defensive and offensive.
It is.
But there is another piece to this, vanadium. I feel like vanadium always plays second fiddle, but it's part of the mix here too, isn't it?
It is, and it's becoming more important. Global exports for vanadium are forecasted to rise to 43.3 million kilograms by 2026. The total market is expected to grow to 98 billion by 2032.
That's a massive market, but vanadium is usually tied to steel, right? Rebar, construction?
Historically, yes, it makes steel stronger, but it's also critical for grid-scale battery storage.
Oh, the big flow batteries.
Vanadium redox flow batteries, exactly. The huge batteries that store solar and wind power for cities. Energy Fuels has the ability to switch circuits at the mill and produce vanadium when the price is right. It's that optionality that makes them so robust.
Okay, but I want to circle back to the money. A $410 million spend. How are they paying for all this? Are they taking on massive debt?
Surprisingly, no. Cash preservation is being managed very well. In fact, the CapEx on the rare earth expansion has actually come in lower than expected in some areas.
That is rare. In mining, the old adage is double the cost and half the speed. Hearing under budget is like spotting a unicorn.
Exactly. And the strategy is clear. Proceeds are being reinvested directly into Growth White Mesa Phase 2, the Vara project in Madagascar, rather than paying out dividends.
Pure growth mode.
100%. They're building assets that will generate cash flow for the next 20 years.
Okay, the story sounds good, but let's pivot to the charts to see what the price is saying. Because fundamentally, a company can be great, but if the stock is broken, it's a tough hold.
Well, the market voted immediately. Following the news of the 2025 beats and the BFS details, the stock rose 10.2% on the TSX.
Double digits in a single day? That is a serious move. That's not just noise.
And it was up 2.8% in pre-market U.S. trading as well. This wasn't just a local reaction, it was a broad re-rating.
That implies conviction. When you see a gap up like that and it holds, it usually means big money is stepping in.
That's right. We are seeing what we call breakout momentum. The stock is making higher highs. And importantly, those positive price gaps on the news suggest that institutional investors, the ones who move the needle, liked what they saw.
They did the math on that $29 production cost and decided to buy.
They did.
It's not just about Energy Fuels in a vacuum, though, is it? The whole neighborhood is getting nicer.
If we connect this to the bigger picture, absolutely. The broader sector is on fire. The nuclear ETF, URA, is being buoyed by the Department of Energy's $2.7 billion uranium push.
Let's just clarify that for the listener. This $2.7 billion, this is the U.S. government saying we are buying uranium to secure the stockpile, right?
Correct. The government is literally becoming a massive customer to secure domestic supply. Energy Fuels is riding this sector-wide wave, but because of their specific execution and the mill, they are outperforming the basket.
So the DOE money is the rising tide lifting all boats, but it sounds like Energy Fuels has a speedboat while some others are on rafts.
That's a great analogy. And the retail crowd is noticing too. We're seeing data that Zacks users are watching quite a bit. When you combine institutional buying with a wave of retail interest, that creates sustained upside potential.
The charts look strong, but let's check the pulse of the market in our sentiment segment. What are the algos saying?
The quantitative score from Alpha Vantage is emphatic. It's a bullish 5 out of 5 positive.
5 out of 5. That is a clean sweep. Let's look at why. I'm reading through the top headlines here. We've got exceeds guidance, asserts dominance. Dominance is a strong word.
It is, and it's not accidental.
And here's another one. Fixing the rare earth bottleneck.
That is the key narrative shift.
Explain that. Why does the phrasing matter?
Because words move markets. The media narrative has shifted from describing energy fuels as just a miner to describing them as a solution provider for U.S. policy goals. When the headline isn't "miner digs up rock," but rather "company fixes national security bottleneck," the valuation multiple changes. Investors will pay a much higher premium for a strategic solution.
That is a crucial distinction. Being a solution provider puts you in the boardroom with policymakers. Being a miner just puts you in the dirt.
Exactly. And looking ahead, the catalyst calendar keeps this momentum going. We have Q4 2025 or full year 2026 earnings expected early in Q1 2026.
So we get another look at the books soon?
Yes. And there was potential M&A activity hinted at in the January 21st call transcript.
Hints and whispers. We have to be careful with those.
We do. And on the macro front, we have continued tailwinds from that DOE nuclear push, plus continued anti-China rare earth policies. Every new policy is a direct tailwind.
Hold on, though. We are getting a little too euphoric here. It can't all be green candles and government checks. Let's do a deep dive into the risks. There has to be a bear case.
You are right to pump the brakes. There are real significant risks.
What are they?
First and foremost, commodity volatility. We have to remember, they are price takers. They don't set the global price of uranium or vanadium.
Right. If the spot price crashes because of a global recession, their earnings crash. It doesn't matter how good the mill is.
Exactly. And specifically on the vanadium side, if steel demand stays sluggish, which we saw in 2024 and 2025, that side of the business hurts.
So if the global economy slows, the vanadium kickstand gets kicked out.
Correct. Then there is the execution risk. With that $410 million capex for phase 2.
It's a lot of money, and complex projects rarely go smoothly.
Construction is messy. Delays, cost overruns, or issues integrating the feeds from their Madagascar project could burn cash fast. That is a long supply chain.
And markets hate delays. If they miss a timeline, the stock gets punished.
Precisely. Now, some analysts argue this is priced in, but the risk remains. A $410 million project is never risk-free.
And what about this M&A stuff?
That is pure speculation. The talk is unconfirmed.
This is where I have to warn the listener. Do not buy a stock solely on buyout rumors.
Excellent advice.
You have to like the company without the buyout.
The fundamentals have to stand on their own. The M&A is just a potential cherry on top, not the cake itself.
So we've seen the numbers and the risks. We see the strategic mode of the mill, but we also see the execution cliff they have to climb. Putting it all together, what's the final call?
When I weigh everything, the beats, the unique infrastructure, the policy tailwinds against the risks, I am assigning a bullish score of 9 out of 10.
9 out of 10. That is incredibly high for a resource stock. Walk us through the thesis one last time.
It comes down to this. Energy Fuels is the dominant player in U.S. uranium and rare earth production. They crush their 2025 targets. They have a clear, mathematically verified path to low-cost production with that $29 NdPr figure.
So the microeconomics work. They can produce cheaply?
They do. And the macroeconomics are even better. The combination of DOE funding and the geopolitical imperative to decouple from China provides a massive safety net and a growth engine.
The U.S. government needs this company to succeed.
That is a powerful position to be in. It's the too critical to fail argument. If Energy Fuels fails, the U.S. rare earth strategy fails.
Okay.
My horizon on this is a multi-year hold. You hold this into the rare earth ramp-up and the eventual turn of the vanadium cycle. This isn't a trade for next week. It's a position for the next industrial cycle.
So what does this all mean for you listening right now? It means we might be looking at one of those rare moments where policy, operations, and market timing align. But as always, the execution is everything. They have to build that phase 2 expansion on time and on budget.
Right.
If they do, that 9 out of 10 score is justified. If they stumble, well, that's why we have stop losses.
That's what makes it fascinating to watch.
That's the breakdown on Energy Fuels, a strategic asset disguising itself as a mining stock. Don't forget to subscribe, like, and comment to this video to support the show. We'll see you in the next one.